let's talk about asset allocation. Earlier this year, you made a pretty important pronouncement and adjustment to your portfolio allocation. And let's talk about what your thoughts are going into 2022. You shifted 20% out of fixed income into equities. So your balance went from 50-50 to 70% equities. Talk about how well that worked and what your thoughts are for 2022.
Well, it has worked primarily because fixed income is a very challenging place. And when I talk about fixed income, it's not just government bonds. I do corporate credits, I do factoring deals, I do bank loans. So we have a pretty big managed portfolio of fixed income. And when we were looking at it early in the year, and even looking at it in the last quarter of last year, we realized that our target's 6% distribution in our operating company from our investments, which may not sound like a lot, but over time it is. And you're certainly not getting helped if you're buying fixed income, because in corporate credits, even 5-year, even 6-year durations sometimes are under 3%. And so the risk there is that you get inflation at some point, because if you have duration risk in fixed income, the value of that instrument goes down the minute inflation rears its ugly head. That's not necessarily the case on equities, where you have the pricing power of companies that pass through inflated costs to their customers, and mostly do so successfully. You can go back in history and look at when inflation comes into the market. Very often, the indexes do much better than the fixed income market. It's hard to know with certainty, but when you know you're getting historic low interest rates that are basically maintained by a very accommodative fiscal policy, that's not a great time to load up on fixed income. Again, in my personal opinion, I'm just managing my own situation according to what I see in the markets. But having been a fixed income investor for decades, I find it very expensive right now. That is why I allocated 70% to equities, 30% to fixed income. I'm not out of the fixed income market, but I'm certainly not happy with what I'm making on a risk-adjusted basis. I don't find it great value anymore.
And so you're going into 2022, maintaining that much higher allocation in equities. Are you doing that with ETFs? Tell us how you're doing that.
I'm using ETFs for equities. I eat my own cooking. Obviously, I'm involved in O'Shares. I'm a very conservative investor. I want to use instruments that give me diversification and less volatility, and that's what I find in O'Shares. One of the reasons I was a co-founder of it. But there's no question ETFs are much easier to manage than individually picking stocks. Now, if you think you're a fantastic stock picker, that's great. But I like the fact that I can go to bed knowing I own very high quality balance sheets inside of the indexes that I own in the O'Shares ETFs.
And so that's OUSA is, I guess, the flagship for us, large cap quality dividends with a yield approaching 2% and historical growth rate of the yield on those stocks that's in the area of 10%. So
yeah, I'm happy to disclose the percentages across the ETFs. So basically, my largest holding is OUSA. That is the mainstream subset of the S&P 500. I like to call it what it is, boring as hell. But when it's your number one allocation, I like boring. It does what it's supposed to do for me, reduces the volatility of the S&P 500, and gives me the best balance sheets that are cash flow positive and distributing cash towards my 6% distribution. We talked about Europe. That's 20% for me, OEUR, for the reasons we discussed. I like Europe a lot, really performing now for all the reasons that Europe should be performing. I also have a mandate in growth, and I use OGIG, which is Internet Giants Global. There's more volatility there, but these companies are growing in some cases at 34%, 30 to 40% a year, and I want some of that. And lastly, I like small cap, but I don't like unprofitable small cap. So I don't buy the Russell 2000. I buy 20% weighting in OUSM, which is basically the profitable companies inside the Russell 2000, slightly larger market caps, more at the 4 to 5 billion range. But that's my portfolio. I like it because for me, it's preserving wealth, but providing me in most cases distributions towards my 6% bogey.
Thanks for sharing that with people. And if you'd like information on any of the ETFs, send us a note, info@oshares.com. We'll provide you the information. If you're an advisor, of course, we can provide you even deeper analysis and info. I'd also like to share with people some charts here that show why bonds are doing what they're doing. Let's just pop those on, please, producer. And the first one on the left shows correlation to stocks. Historically, bonds were expected to go up when stocks went down because interest rates would often follow down and push the bond prices up. The correlation has gone positive, Kevin, to positive 0.3. So that means instead of getting a cushion, your bonds are going the same direction as stocks much of the time. So that's no longer a cushion. It's in fact correlation, positive correlation. The chart on the right shows what you were talking about. The credit spread you get on corporate bonds now is very, very small, 86 basis points compared to where it used to be at or above 200 basis points. And these are a couple of the reasons perhaps that some of the bond luminaries are saying that bonds are now investment grade garbage or something like that, is the headline that came out not that long ago. So this kind of backs up what Kevin's been talking about. Bonds aren't doing for people what they used to do. The yield isn't there. The shock absorber cushion isn't there. And the risk of spreads widening is a greater risk today than it used to be because they're so tight today that the impact of a widening could be pretty damaging. So that's the story on asset allocation, on why Kevin has shifted so much to equities out of bond, the data on it, which we're happy to share with you, and also some insights for people on Kevin's allocation on the equity side. Thanks for sharing that, Kevin.